So you said that you don't make model portfolio, you customize the portfolio. When I say you customize, as in you do it the way you want to deploy, is that the timing may change, right? So you may have a different stocks and you may take a cash call, or how is it?
So for us, so let's assume, I'll give you an example. Let's say we have a certain company which we've been invested in for a while now, and it's done very well for us. The weight of the company has gone up to 13-14% today. Now, when new capital becomes available to us, that company will not be 14% anymore for a new investor. We might still like that company, but because of the risk reward and the fact of the valuation comfort, we might start off with only a 3% allocation. So that difference of 11% will automatically go into cash. Now we have two questions to answer. Are we going to invest that 11% back into the same company, or are we going to increase and upsize the position of another company? So as analysts, we are always working on new ideas, and if we find a new idea suitable, you will see us deploying the cash into the new idea. Or if this company goes through a correction, many people are talking about the IT correction today, right, which is not significant, but at least it is a beginning versus what you saw in the last 2 years. You might see some interesting opportunities come up there again, where we might increase our weights. So these are the two things that we would do as we look to redeploy over the course of the next few months. That's how we think about risk.
So it depends on markets levels, etc.
Yes, it purely depends. So the companies are kind of fixed, right? The question is the how you manage the exposures, because just stock picking is not the only job of a fund manager. Exposure sizing and position sizing is an even more important job of a fund manager, and that's something that very few people focus on.